สวัสดีค่ะขอบพระคุณนะคะทุกท่านที่ให้เกียรติเข้าร่วมงานเวบินาร์ Series in Common Issues in Early Stage Fundraising นะคะวันนี้นะคะเราก็จะมาพบกันในหัวข้อ Secrets of VC Valuation Reviewed สำหรับวันนี้ค่ะแนนนะคะธนันพร เศรษฐจินดาขอรับหน้าที่เป็นพิธีกรดำเนินรายการค่ะงานวันนี้ค่ะจัดขึ้นภายใต้ความร่วมมือระหว่างตลาดหลักทรัพย์แห่งประเทศไทยโดยห้องเรียนผู้ประกอบการนะคะและ Expara Thailand ภายใต้โครงการการรับมือและฟื้นฟูธุรกิจอย่างเร่งด่วนโดย Youth Business International และได้รับการสนับสนุนจาก google.org ในวันนี้ค่ะเราได้รับเกียรติจากทางตลาดหลักทรัพย์แห่งประเทศไทยนะคะโดยห้องเรียนผู้ประกอบการค่ะที่จะมากล่าวต้อนรับจากนั้นค่ะทุกท่านจะได้รับฟังการบรรยายจากคุณดักลาสนะคะเราจะเปิดเวลาให้ท่านถามทุกคำถามอย่างเต็มที่ค่ะโดยในลำดับถัดไปนะคะดิฉันขออนุญาตเรียนเชิญคุณนุชนาถคุณความดีผู้อำนวยการฝ่ายพัฒนาความรู้ผู้ประกอบการกล่าวต้อนรับและเปิดงานเสวนาในวันนี้ค่ะเรียนเชิญค่ะ
สวัสดีค่ะ Hello everyone อาจารย์แนน and คุณดักลาสสวัสดีผู้เข้าอบรมสัมมนาทุกท่านนะคะก็ขอต้อนรับทุกท่านเข้าสู่เสวนาพิเศษนะคะในซีรีส์ Common Issue in Early Stage Fundraising ซึ่งจะพาทุกท่านนะคะได้เปิดมุมมองด้านการระดมทุนในโลกของสตาร์ทอัพแบบเชิงลึกเลยนะคะโดยเฉพาะสตาร์ทอัพในระยะเริ่มต้นเนี่ยคิดว่าได้ความรู้ตรงนี้เนี่ยตรงประเด็นแน่นอนค่ะสำหรับตลาดหลักทรัพย์เองนะคะโดยห้องเรียนผู้ประกอบการนะคะจากที่ท่านเห็น VTR นะคะแล้วก็ยังคงที่จะมุ่งเน้นนะคะที่จะส่งเสริมนะคะแล้วก็สนับสนุนการพัฒนาศักยภาพของผู้ประกอบการไทยนะคะโดยเฉพาะในด้านความรู้และทักษะต่างๆนะคะก็อยากจะเชิญชวนทุกท่านนะคะที่เห็น VTR ก็คือเรามี e-learning มี micro learning ที่น่าติดตามเข้าใจง่ายกระชับแล้วจริงๆก็คือทันสมัยมากนะคะดูแล้วก็ไม่เบื่อเลยนะคะเราก็ทำงานนะคะก็ไม่ได้ทำคนเดียวแล้วก็มีพาร์ทเนอร์มากมายนะคะโดยเฉพาะครั้งนี้นะคะเราก็ได้ร่วมมือกับทาง Expara นะคะในโครงการรับมือและฟื้นฟูธุรกิจอย่างเร่งด่วนนะคะอย่างที่อาจารย์แนนนะคะเรียนให้ทราบซึ่งการจัดงานในครั้งนี้นะคะก็ถือว่าเป็นครั้งที่2ของซีรีส์นี้แล้วนะคะโดยครั้งแรกเนี่ยที่เราจัดร่วมกันเนี่ยอยู่ในหัวข้อเรียกว่า Building a Fundable Company Begin with the Right Structure นะคะสำหรับท่านที่พลาดไปนะคะก็ไม่ต้องกังวลนะคะเราสามารถกลับไปดูย้อนหลังได้นะคะซึ่งทีมงานของทางอาจารย์แนนนะคะจะทิ้งลิงก์เอาไว้ให้ในแชทบ็อกซ์ค่ะส่วนหัวข้อในวันนี้นะคะก็คือ Secrets of VC Valuation Review นะคะก็จะเกี่ยวข้องกับการประเมินมูลค่าของสตาร์ทอัพในมุมมองของ VC นะคะโดยคุณดักลาสเนี่ยอย่างที่ทุกท่านทราบนะคะท่านเนี่ยเป็นผู้เชี่ยวชาญด้านการระดมทุนสำหรับ Early Stage เลยโดยท่านจะมาถ่ายทอดนะคะทั้งความรู้เทคนิคต่างๆนะคะจากประสบการณ์กว่า20ปีนะคะซึ่งท่านเนี่ยเชี่ยวชาญด้านนี้มากๆเลยนะคะก็เลยคิดว่าทุกท่านเนี่ยถ้าเกิดเข้าร่วมวันนี้แล้วเนี่ยจะได้ประโยชน์กันอย่างเต็มที่นะคะแล้วอย่างที่อาจารย์บอกนะคะว่าถ้าสงสัยอะไรให้รีบถามเพราะว่าเราก็จะไม่ได้เจอกับคุณดักลาสแบบตัวเป็นๆอย่างนี้นะคะยังไงวันนี้ก็เป็นโอกาสดีแล้วก็ทิ้งท้ายนะคะไว้ที่คำถามได้เลยนะคะซึ่งคุณดักลาสเนี่ยแกชอบตอบมากและแกก็ใจดีนะคะโอเคสุดท้ายนะคะ Finally, on behalf of the Stock Exchange of Thailand, I'd like to thank Expara, especially Douglas and Ajanen for inviting SET to work together in this project for dissemination knowledge for Thai entrepreneurs. We also have interesting topic which will continue to be held in February until April that I want everyone don't miss the practical knowledge ค่ะยังไงก็สุดท้ายก็ขอบคุณทุกท่านอีกครั้งนะคะ Thank you and สวัสดีค่ะ
ขอบพระคุณนะคะคุณนุชนาถค่ะและตอนนี้นะคะก็ถึงเวลาที่ทุกท่านรอคอยแล้วนะคะคุณดักลาสค่ะ Okay, Douglas, this is the time that everybody is waiting for. Ladies and gentlemen, please welcome Douglas Abrams, founder and CEO of Expara. Douglas, we are ready to hear your secrets. Over to you.
Okay, thanks so much, Nan, and thank you, Stock Exchange of Thailand, for your partnership and assistance on this program, which we hope to help entrepreneurs in Thailand to gain valuable and practical knowledge. Originally, this program is designed to help you to recover from the damaging effects of the COVID pandemic, but we're continuing through the first quarter of this year to try to help during the recovery also. So tonight's topic, I think one of everybody's favorite topics, which is secrets, I call secrets of VC valuation. I will share with you, I'm not sure how much of it is really secret, but I will try to explain from the perspective of somebody doing VC valuation for many years in Southeast Asia, how VCs think about valuation, how this should impact your thinking about valuation if you're an entrepreneur, or also share with fellow investors who are joining our talk this evening. So I'll try to leave as much time as possible at the end for questions, because we do have some pre-submitted questions, and I would like to address as many of your questions as possible at the end of the program. So let's jump in. I think we can skip over this. I think everybody knows my background, or they can go check the bio later, but go straight to background on the VC valuation. So in order to understand how VC valuation works, we need to look at the landscape that venture capital investors and startup companies are operating in now. These two lists of companies show on my left side, the 5 most valuable companies in the world 12 years ago, and on the right side, the 5 most valuable companies in the world last year. And what's interesting about this list is you see that the only company on both lists is Microsoft. All 4 new companies on the right side and Microsoft are all companies that were startup companies who were invested by venture capital investors. So we can see from this small sample, the way that venture capital investment and startups are not just a niche part of the economy, but are actually driving the growth in the global economy. And to further highlight that point, this analysis, which we did back in 2020, I think hasn't changed too much since then. We looked at the highest valued unicorn companies. So these are startup companies that have achieved valuations way beyond 1 billion, or even decacorn beyond 10 billion. We picked the top 10 most valuable startup companies in the world at this time of this study. Total market cap of those companies was $530 billion US. And if you add up the combined market cap of the top 10 companies trading on the SGX, the SET, and the Vietnam Stock Exchange, these 10 startup companies are worth more than those 30 companies combined. So here we can see again how venture capital invested startups and venture capital investment is really changing the whole face of the regional and global economies. Now, when in our program, we deal with all types of entrepreneurs. So in our YBI program, we deal with SMEs and startups. So just to quickly mention the difference between SMEs and startups, both are small, but SMEs are small and will grow slowly over long periods of time. Startups are small, but will grow quickly over a short period of time, or generally die. So startup company is going to either grow big fast, or it's going to die probably relatively fast. SME is going to grow slowly over long periods of time. Now, if you take a look at this graphic, which shows many companies that were many startup companies that were invested by venture capital investors, I think the single unifying characteristic, or the most important unifying characteristic of these companies, is that every one of these companies is or was number one in its product category in its market at one time. Some of the companies still are, some have long not been, but at least they were at one time occupying that position. And if you think about it this way, if you pick a product category like coffee, you have Starbucks, social network, Facebook, search engine, Google. You can see this list is basically globally successful companies who are number one in their product category in the market. So we all know these companies. And what I like you to take away from this is the fundamental mission of venture capital investors is to invest in companies that will be populating this graphic 5 to 10 years from now. So that's the basic, that's the idea behind successful venture capital investment. You need to invest today in a company that will be number one in its product category in its market in the next 5 to 10 years, will be a name like one of the names on this list. Now, for us in Southeast Asia, it might not be a globally successful company. It could be, or it might be a nationally or regionally successful company. But we have to spot those companies very early, invest in those companies very early. They will, if they're successful, they're going to grow very big, very fast, and generate very high returns. Now, how do VCs make money investing in companies like that? We invest in the company before it becomes hugely successful at a reasonably low valuation, which we'll talk about later in the program. And then the company will increase in value and we sell the shares and we make the difference between what we paid and what we receive in the sale of the shares. So there's two ways we can sell our shares. Trade sale, which is the other side of an M&A. So a large company buys our startup, or an IPO where our startup lists their shares on a public exchange and we get a chance to sell our shares. So this is really important to keep in mind, because if you think about the way that most companies, the vast majority of companies that we know, publicly traded companies, generate value for shareholders two ways: through dividends and through capital appreciation, increasing the value of their shares. Startups don't pay dividends. So startups only generate value for their shareholders through capital appreciation followed by exits. So this is going to become very important when we look at how to value the startup. And one point I like to make here, every investable startup needs to have an exit strategy. If there is no exit, VCs make no money. So a startup without an exit strategy is equivalent to a startup that is pitching to investors that they're never going to make any money. And when we look at the distribution of VC exits, this is data from the US, and I think it's pretty good data based on a very large data sample, but not from Southeast Asia. But we can assume that actually Southeast Asia results will be skewed even further in this direction, meaning 90% of venture-funded exits in the US are trade sales. And why I think that Southeast Asia data will be more skewed toward that is because the US has the largest number of venture-funded IPOs in the world. So there's, you can see here that the way I like to think about this is you are 10 times more likely as a startup who's going to exit in a trade sale than you are in an IPO. And median value as of 2019, median value of trade sale acquisitions of venture funded startups in the US was $100 million US. Let's keep that number in mind, because that's going to be an important number when we look at some of the valuation methods that we use to estimate the value of startups. And if we look across all exits, median valuation, again, this is looking at 2019, was $161 million US. So we can see that the US IPO exits are huge and they drive the average way up. But if you look at regional exchanges, you can see that the regional exchange numbers are actually pretty low compared to the US, and some of the regional smaller exchanges are even less than average trade sale exits. We can also see one other factor difference between trade sale and IPO exits. Trade sale exits happen much more quickly, average 5 years to almost 7 years for IPO exits. So, okay, with that in mind, so now we understand, we reviewed how what are VCs looking for in terms of the type of company they want to invest in, how do those type of investments generate returns, and what's the method that the returns are going to flow to the VC. So let's look at now, how do we value startups? So before we go into specific methods, I want to highlight a challenge that we have in valuing startups, which is most valuation methods fail for startups, meaning the traditional valuation methods that we use for valuing traditional or publicly traded companies will not yield a meaningful valuation for many startups. And why is that? The traditional valuation methods, the ones that we all learn in business school or in university, or the ones that you are familiar with through your work, if you're involved in financial services, are basically designed to value publicly traded companies. And I mentioned previously, these companies can create value for shareholders through either capital appreciation or dividends. But startups generate value for investors only through exit, trade sale, or IPO. And therefore, for a valuation method to yield a meaningful result, the valuation method needs to reflect the real value to the investors, not the value that this company would be delivering if it was a publicly traded company. These are the 6 most common valuation methods that you're probably familiar with if you do some valuation or look at valuations. And we'll quickly go through the list. We can't use a price to earnings method to value a startup because the scalable startups typically focus on growth, not earnings. And growth and earnings are, to a large degree, inversely related. So if we take a look at some of the most highly valued startup companies in the world, if we went back and looked at that list, we're going to see many of them have no earnings or very, very small earnings compared to their revenue. Clearly, price to earning valuation is going to way undervalue startups. And you can see an extreme case when we value startups with no earnings, obviously they don't have zero value. Dividend yield, we can't use because startups don't pay dividend. Multiples of book value, not meaningful for high growth startups. So we're left with comparables, discounted cash flow valuation, and the VC method. So comparables are always challenging to do because valuing a company with comparables, we have to have first companies which are actually comparable to the target company. We have to have data on those companies. Both of those will be very difficult to come by for startup companies. However, we can use a variation of comparables method for valuing startups, which I call comparable by stage or rule of thumb valuation, where although the valuations of startup companies are not published on a large scale, we do in the industry, if you're involved in venture capital or startups, you probably have a pretty good sense for what are the range of valuations in the pre-seed, seed, post-seed, pre-series A, series A stage of development. So we can apply that as I like to apply that as a reality test or reality check on any other valuation that we get. So for example, in Southeast Asia, my view is seed stage, or let's say pre or very small revenue startups, usually valued between $1 and $3 million US. So that's a comparable range for me. If the valuation from any of the other methods is way outside that range, then we have to take a look at what's driving that discrepancy. Discounted cash flow valuation is the gold standard for valuing publicly traded companies. This is the one everybody learned in business school or in your finance job. And this is also a little tricky to use for startups because just as startups are not focused on earnings and cash flow is a subset of earnings, the cash flow valuation method may tend to undervalue the startup. I do have some, we can adjust the discounted cash flow method though to get, I think, a meaningful result for startup valuation, but we have to avoid confusing our startup again with publicly traded company. Make sure that we're using the proper assumptions in our discounted cash flow valuation method to avoid getting very bad, meaningless results. And the last method, VC method, is I think that it's my preferred method for valuing startups. I believe that this is the only method that truly reflects the value of the startup to the investor, because it estimates the valuation of the startup based on the real method that the startup will be using to deliver value to the VC shareholders. So I talked already briefly about this, but this is just a little more detail on challenges in comparables method. And I already mentioned we can use comparables by stage to avoid the problems that we would otherwise have doing traditional comparable valuation. So DCF valuation method, the company valuation is the discounted present value of future cash flows. Will every startup should do, or if they don't do, their VC will do a 5-year financial forecast of the company that, based on the revenue, subtracting out the expenses, we'll get the net income, we'll get the cash flows, and we will then discount back the value of those cash flows to the present value, and then we'll add that number to the terminal value of the cash flows beyond the forecast period, and those two numbers together will give us the present value of this company. And this is, I think we do discounted cash flow valuation of every company that we're looking to invest in, and I teach this in every class because I think whenever you're dealing with investors that understand valuation, they're going to want to see discounted cash flow valuation method. The trickiest part of successful discounted cash flow valuation method for startups, and the mistake that I see many people, entrepreneurs, and even some investors doing when they do a discounted cash flow valuation for a startup is they use the wrong discount rate. What do I mean by that? The appropriate discount rate to use for discounted cash flow valuation for any company is the company's weighted average cost of capital, which is the company's cost of debt and weighted cost of debt and weighted cost of equity. But the startups that we invest in, they're almost all 100% equity funded. So their cost of capital is their equity cost of capital. And when you learn to do DCF and you do a weighted average cost of capital for a publicly traded company, usually you'll come out with a cost between 10 and 20%. So I see many discounted cash flow valuations for startups in that range because the person doing the valuation forgot how to calculate that discount rate. They thought it's just supposed to be in that range every time, but it's not. It has to reflect the company's true cost of capital. I'll see some valuations where the person doing the valuation has adjusted up a little bit to say 30% because they do remember somehow this is supposed to reflect the risk in the investment, but it's still way too low. So to make your discounted cash flow valuation work for early stage startup, you need to use I think you need to use a discount rate between 80 and 120%. And later I'll talk about how that matches the VC method. Now, one point I want to mention, because this is very fundamental, but sometimes some market participants not 100% clear on this. So there are two ways to describe the valuation of a company. They both refer to the exact same thing, which is the value of the company, but pre-money valuation is the value of the company before investment, obviously, and post-money valuation is the value after investment. So the relationship between those two numbers, pre and post money, is very simple. It's the amount of the investment. And the important point here to remember is when we calculate how much equity goes to an investor, the formula is the investment divided by valuation, and the valuation number in the denominator is always the post-money valuation. So don't forget that. I see people sometimes confuse those two and then get make a very big mistake. Okay. Now, the last method is the VC method. Now, this is a formula for VC method, but it's very detailed. So I'm not going to go over that now. You can review this one after. We'll go to, now this is the way I like to explain the VC method, because this is a simple way to understand how VC method works. So if we think about the VC's return, since there's no dividends, the VC's return is going to be equal to the exit valuation divided by the current valuation. Now, how does that work? So let's say if the exit valuation is 100 million, and you remember 100 million was the average exit valuation, median exit valuation for M&A in our study of VC exits. So let's say exit valuation is 100 million, current valuation is 2 million. That means that the VC's return is going to be 50 times, because 100 divided by 2 equals 50. If the exit valuation is 100 million still, and the current valuation is 4 million, then the VC's return is going to be 25 times, because 100 divided by 4 is 25. So it's very simple. And we can very quickly value any startup using this method, because the way I usually approach this, just ask the entrepreneur, how much are you going to exit for? What is your anticipated exit valuation? And then let's say they say we're going to, sometime I'll have the entrepreneur say they're going to exit 40 million. What's the current valuation? 4 million. So that means the return is 10x. Now, I have simplified the calculation for a minute because I want to illustrate the concept. Now, this formula only works if we are not diluted. So this assumes no dilution between investment and exit, which is unrealistic, but we'll adjust the formula for that in a minute, and the concept stays unchanged. So at seed stage, the VC's required return should be 30x. And on average, seed stage investors will be diluted by 50% between investment and exit. So we can use that information to adjust our VC method valuation by saying current valuation equals exit valuation divided by 60. If you can see, if you compare the line 4 to line 1, you'll see that's just a transformation of the line 1 formula adjusting for dilution. So now, let's say we talk to any seed stage startup. So we can estimate the valuation by just dividing their projected exit valuation by 60. And you can see that, interestingly, if we divide 100 million by 60, that leads to 1.6 million, which is right in my range of 1 to 3 million that I mentioned was the comparable method, that would be my comparable by stage for the same company. So in that case, you can see how the two valuation methods reinforce one another. The VC method reinforces the comparables method and vice versa. Now, you might wonder, where does this 30x come from? Because 30x is the key number in this VC method valuation. Where it comes from is investors in venture capital funds are going to require somewhere between 20 and 30% IRR for a 10-year fund. And this number is not set by VCs, it's set by investors in VC funds. If in order for a VC fund to deliver 20% for 10 years, in order for a VC fund to deliver 20% for 10 years, the fund needs to deliver a 6x gross multiple. You can work that out in Excel, you're going to see. This means, naively, this should mean that each successful startup needs to deliver 6x, which you think should change our 30 to 6, but it doesn't. Because why? Only 20% of investments will exit at more than one time the original investment amount. So this means that 20% of the investments must grow to 600%, which means 30x. Now, in case that was confusing, now I'll illustrate on next slide. So you can see if 100% of our investments would succeed, in order to deliver the 6x that investor in the fund require, each investment would need to deliver a 6x return. But if only 20% of investments succeed, which is the reality based on the data, then each successful investment needs to deliver 30x, and that's where the 30x comes from. So I mentioned already, investors in VC funds set this cost of capital, not VCs. VC portfolio returns are not normally distributed. We'll look at that in a minute. This means that most VC invested startups fail to return capital. This means that the small number of startups who succeed must pay for all the losers, and VC holdings in successful startups will be necessarily diluted because successful startups raise many rounds of funding. Now, this is a chart that shows the VC cost of capital. So you can see that when we look at the returns to investors in venture capital funds, the top 25% of venture capital funds return 25% per year to their investors. This means that investors are going to require between, I said 20% because you can see here, mean return is 16, top 25% is 25. So all VC investors are going to want at least 20% and probably going to want 25%. And this means we have to get the 4 to 6 gross multiple that we talked about earlier. And we're going to find over time, all VC funds will need to deliver this same return multiple, because otherwise they will exit the market because they won't be able to raise their next fund. This is a distribution of venture capital returns versus normal investment portfolios. So I think everybody who's looked at investment knows that typical investment portfolio has a normal shaped distribution of returns, like the bell curve in the center of this graph. So most of the investments in your portfolio deliver the average return. And as you get way above or below the average return, a very small percentage of the portfolio delivers that return. 2/3 of your portfolio delivers within 1 standard deviation of the mean return, and 95% delivers within 2 standard deviations on average. But that's not how venture capital fund returns are distributed. Instead, in venture capital funds, a very small percentage of the investments drive almost all the returns. And this is a real study of venture capital fund returns. And it's actually the inverse of the chart that we just saw, because here you can see that the vast majority of investments that venture capital funds make into startups deliver either 0 or less than 1-time return. We can see that on the pie chart, next pie chart. So this is looking at the first round of non-seed investment, meaning post-seed. You can see that 74% of the investments fail to return capital. Of that, almost 50% go to 0. So that means not no return, not return to principal plus nothing. It means principal is lost. 25% means return of capital plus nothing. So that's less than less than return of capital. So less than 1 time. So 74% are either 0 or less than 1 time. And you can see the tiny slice at the top, which is 3%. These are the investments that return more than 20x. And that's what the power law distribution predicts. The very small percentage of the portfolio will drive almost all the returns. And this distribution doesn't change that much from stage to stage. So even at Series B, we still see a very small percentage of the portfolio delivering most of the returns. What does vary a lot by stage is dilution. So this pie chart shows an example. Seed investor invests and gets 20% of the startup, which is a not unusual equity amount. By the time, assuming that this startup raises 4 subsequent rounds of funding, which is about average, the seed investor would have been diluted to nearly 40%, nearly half of their investment. So you can see they start out with 20, they end up with 10. And this is assuming pretty conservatively that each investor in each subsequent investment round diluted the seed investor by 15%. But clearly, Series D investor isn't diluted at all before exit. Series C investor is only diluted by 15%. So we will see that the required return will be adjusted, I think, predominantly because the amount of dilution will go down. Now, when people hear about dilution, oftentimes I think they think dilution is bad, but actually dilution is not bad. Dilution is good because if in the vast majority of cases, if there's no dilution, it means the company's not raising future funding rounds, which means they're probably either dying or they're not getting to a profitable exit. So dilution itself is not bad as long as it's normal dilution. This table illustrates, shows an example of normal dilution where the company raises several rounds of funding, but in each round of funding, the valuation goes up enough to offset the dilution. So as long as the valuation is increasing enough from round to round, the investors, although being diluted, will make money, because you can think about it this way. As an investor gets diluted, their slice of the equity pie gets smaller, but as long as the overall pie is getting bigger than the proportion that their slice is declining in size, they'll make money. And this is just another way of saying small number of winners must pay for losers in VC portfolios. I did another very quick and dirty analysis of venture capital fund of a startup company looking at 100 million exit valuation, and you can see that the current valuation comes out to exactly the same, the 1.6 million that we talked about in the previous example. Now, you might, one thing when we talk about valuation, when I talk to entrepreneurs about valuation, and one of the, I think not exactly secret, but one of the things that entrepreneurs don't always think about when we consider valuation, clearly entrepreneurs know that getting too low of a valuation is something they don't want. They don't want to be undervalued. And I think that's fair. I also don't want to be undervalued if I'm a startup. And I don't believe in undervaluing our investments if we're a VC. I think good valuations are fair valuations. But one thing that entrepreneurs don't always think about is the problem with overvaluation. If the company is overvalued, it can be as bad as being undervalued. Why? I like to say, actually, as a startup, for a startup, it's okay to be overvalued until it's not. So if you're overvalued in any particular round of funding, it might not be the end of the world, but it can become the end of the world when you are overvalued in one round and you meet an investor or acquirer in the next round or a subsequent round that values you fairly. Because if previous round valuations are too high, in subsequent round funding or in exits, all the shareholders are going to suffer, but typically founders are going to suffer more than other shareholders. Now, why? Some of the examples, the company can, because it was overvalued in the previous round, company can have a down round that entails massive dilution. And one very common situation, if a company was overvalued in a previous round, it's likely that investors had anti-dilution, which means that when a company has a down round with massive dilution, the burden of that will be disproportionately borne by the founder shareholders versus investors. Overvalued in a previous round can lead shareholder investors to block a sale at too low of a price because the acquirer is offering a fair, let's say a fair price, but the company was overvalued in the previous round. Or in some cases, most tragically, company may be sold at a low price. And again, when companies are overvalued in previous rounds, investors are likely to have wanted liquidation preferences, which means non-liquidation preference bearing shareholders, which are usually founders, will take the brunt of this scenario. So one possible example of that, I don't really have I don't know what were all the numbers here. This is just from publicly announced numbers, but there was a startup in Singapore called Redmart that in January 2016 set out to raise a $100 million funding round. So I estimate, I don't know this is just my estimate, but thinking about the typical valuation ratio. So if you're raising 100 million, you're probably valuing your company at least 500 million because you don't want to give up more than 20% if you can help it. So let's say valuation somewhere between 500 and 1 billion. Again, just my estimate. 11 months later, that company, this was publicly announced, that company was sold to Lazada for between 30 and $40 million. Previously, again, public data, this company had raised 55 million in venture capital funding. Now, I don't know what were the terms of the venture capital funding, but if most or all of those VC investors had a liquidation preference, that suggests that this company had $55 million in liquidation preference, which could have led to the preference shareholders taking all, because the way liquidation preference works is first use of the proceeds from a sale like this is to pay back the preference holding shareholders. So because the sale price was less than liquidation preference, founders might have got zero. And again, that's a company that was sold for, let's say, $40 million. Founders might have got zero. Why? Because the company was too highly valued in previous rounds. And if you look at this chart again, you can see how the ratio of my divide by 60 ratio leads to a very reasonable range of valuations for startup companies with different exits. So you can see 7 million US for a startup that's going to exit in the US NASDAQ or New York Stock Exchange IPO. And actually at the time of this study, 7 million was about the average valuation for seed stage companies in the US. And looking at our $100 million trade sale, 1.7 million again, which is pretty close to the market. Now, just to do so I'll do a quick example of how to value your company using the VC method that we talked about. So, and then cross-checking that with comparables and DCF. So you do the 5-year revenue forecast and you use the 5-year revenue forecast to calculate the exit valuation for your company. So for example, let's say that your year 5 revenue forecast is 30 million in revenue, and the revenue multiple for your sector in M&A is 5x. So this means your exit valuation will be 150 million. One very common mistake I see entrepreneurs when they do this, calculate the exit valuation. So they plug in a revenue multiple here. For example, in this case, let's say sector multiple is 5. They plug in 20x here, and that'll give them exit valuation 600 million. Then I ask, where did you get that like 20x when the sector multiple is 5? And they will have selected one outlying example. So there'll be one company that they know or read about that got 20x in their M&A, and they say that's the revenue multiple that we're going to use. Now, this is, I can understand the appeal of that method because this gives you very high exit valuation. But the problem is if you use outlying numbers to do the calculation, then the calculation no longer makes sense because then you might as well just pick any number. And this method makes sense because it's based on average for your sector, and then that creates a benchmark. Now you could still try to get more than that. Yeah. Let's say sector average is 5, but you think the top 20% is 7, so it's fair to put in 7. But you can't put in 60 because somebody had some freakish outlier had 60. Same way you don't want to put in 1.2 because some freakish low outlier had 1.2. Okay, so we have our exit valuation 150. Now if we're seed stage, we can divide by 60. As we talked about before, to get 2.5 million valuation. And if we're Series A, we can generously maybe divide by 30 because of less dilution and get a value of 5 million. Now we're going to cross-check that. So yeah, we talked about 1 to 3 million for seed stage companies. So 2.5, we're still in that range. For Series A, 5 to 10 million. And again, we're still in that range. And then cross-check with DCF. Again, make sure you're using the proper discount rate. Now, often when I get pushback from entrepreneurs who have done DCF method and I compare it to VC method, I have heard entrepreneurs say, VC method doesn't work because it differs from my DCF method. And it's not correct. Actually, both methods work with proper assumption. So if the DCF method uses the right discount rate, it's almost, I can guarantee it's going to align with the VC method. And this is actually, when the entrepreneur has used DCF valuation or the wrong discount rate, it puts them in a very bad negotiating position, because I just begin the negotiation by saying, oh, you use 30% discount rate. Well, let's accept everything else in your discounted cash flow valuation is correct. Let's assume that your revenue, your expense forecasts are all correct. And now all we need to do is change the appropriate discount rate. So if you did the valuation with 120, with 30% and we changed to 120%, your valuation is going to go down by 60, 80%. And it makes it very hard for you to recover from that, because what's the argument? The changing the discount rate shouldn't affect anything else in your model. So if you're going to use DCF, make sure you use the right discount rate. Okay, and then this is the last thing I want to talk about. And this is sort of, I think, of the secret that we talked about tonight. I mentioned being everything not really secret, but I think this is something I consider really important sort of secret is everything that I talked about so far doesn't determine how your startup is valued. Everything that we talked about so far is just about estimating the value. So you need to estimate your value as an entrepreneur. VCs will estimate your value as an investor. So comparables method, discounted cash flow valuation method, VC method, they're not determinants of valuation. They're determinants of negotiating positions for valuation. And if you think about it this way, valuation is a price. Valuation is the price that the startup is asking the investor to pay. And prices in markets, so this is a market for capital. The startup is trying to raise capital, and therefore they're operating in a capital market. The price is determined by what in a market? The price is determined by supply and demand. So the actual final valuation for your company is not going to be determined by anything that we talked about up until now. That will just enable your initial negotiating position. In the end, valuation is determined by negotiation. And what causes one side or the other to win in negotiation is the negotiating power, supply and demand of the investment capital for the startup. So if there is more demand for the startup's equity or greater supply of capital for this startup than they need, then the valuation will be higher. If there's less demand for the startup's equity or supply of capital is less, then the valuation will be lower. So this actually tells startups how to get the highest possible valuation. How to get the highest possible valuation is to create a competitive market in your equity. And how do you do that? You get more than one interested investor. If you have one interested investor, so if we think about the range of valuations that you're going to get, let's say there's the investor's valuation estimate, which is the low end. There's your valuation estimate, which is the high end. If you have one interested investor, the valuation is going to be very close to the investor's valuation because there's no competition, and therefore the market is tilted way toward the investor. If there are multiple investors interested, then the valuation will be maybe not only closer to your end, but the valuation may go above your valuation, because if there's enough competition for investment in your startup, then you're going to see it's possible for investors to bid up the valuation even above the high end of the range. And again, I can't say this with inside information, but just I'm very confident that whenever you read in the news or whenever you see in the tech press a startup that got a valuation way outside the expected range, or one of these apparently crazy outlying valuations that nobody can understand, and that hopefully you're not using now as the multiplier in your valuation, that those outlying valuations are almost always determined because of competition among investors. So there were a lot of investors that wanted to come in and they bid up the valuation, and that's why the valuation was so high. I personally don't like to get involved in those type of situations. I think it's a very strange situation when you're in an auction trying to invest in a startup and bidding up the valuation, because it's the only situation I've ever seen where you win by paying the highest possible price. Usually you win by paying the lowest price. So I think that's not the game that I like to play, but definitely you will, now you should know, if you see one of these crazy outlying valuations, you can be almost sure there were many investors competing for that deal. Okay, so that's brings me to the end of what I would like to talk about valuation. Hopefully you learned a few things you didn't know already. Hopefully you got a few somewhat secrets and better informed about how investors are thinking about valuing your startup. And I'm going to go now to the question and answer. Okay, so I'll start with the questions in the Q&A. Question 1, no exit, no return. What if VC received dividend can treat as return? So of course, if the VC received dividend, this would be treated as return, but VCs don't want dividends. Now, why don't VCs want dividends? VCs are trying to maximize the return on each investment. Remember, I talked about we want to get 30x per investment. 30x is a lot. In case it's not, you haven't worked out the math, 30x is 3,000%. So it means 30 times. And dividends reduce capital appreciation. When companies pay dividends, this means that the value of the firm goes down by the amount of dividend paid. So VCs will almost never want startups to pay dividends. So dividend strategy, it's not consistent with VC's cost of capital. Why is it that VCs need these high returns? It's not because they just desire high returns. It's because they have a very high cost of capital. The investors in our funds want very high returns. They don't want dividends. If they wanted dividends, they would invest in publicly traded companies. Okay. Next question. Should entrepreneur be the first one to name desired valuation or let investor make the first move? So entrepreneurs definitely have to have a valuation. The entrepreneur needs to ask in their pitch. When I get a pitch from an entrepreneur that doesn't have a valuation, I find very confusing, because if you're an entrepreneur pitching to an investor, you're selling equity. I'm looking to buy equity. So if you're selling something, then you have to have a price that you're selling at. If you don't have a price, imagine you go into you're in a store, or you're in a auction or negotiation with somebody who's trying to tell you something and they don't have a price, or they won't give you a price. It's very inconsistent with what they're trying to do. Entrepreneur also without a valuation, it makes me wonder, how are you even raising money without having carefully thought of your valuation? And sometimes entrepreneurs will say, oh, we'll leave that to you. And then, that's also, I don't think the position that you want to be in, because if the investor is going to set the valuation, they're going to set it low. So your valuation should be the valuation that you want. And in most cases, the entrepreneur will be setting the valuation, should be proposing a valuation that's a little above what they want, because once the entrepreneur launches a valuation, you can be pretty sure investors never going to pay more than that. Okay, next question. In the early days of the startup, for example, an idea stage, how best to value our own pre-money valuation? So I think hopefully that question was answered tonight, because you notice that and this is one of the great benefits of the VC method. You notice that the VC method of valuation did not require the company to be beyond the idea stage. As long as we can estimate the exit valuation, we can use the VC method valuation. So VC method valuation will work whether the company is in the idea stage or in the late growth stage. So the next question, how do we trust the target company? What is the criteria or KPI to concern? So not sure exactly what this question means. Maybe the target, maybe this is from the perspective of the investor. How do we trust the company that we're investing in? What is criteria or KPI? So not exactly sure what that means, but I definitely agree. I would say that you do have to have a high degree of trust in startups that you're going to invest in, because when we invest in startups, there's very little public information available about these companies. So you have to, best situation is the entrepreneurs or the founders, or they know somebody that you know, and that helps you develop trust. But there is a lot of trust required in this business. So next question, how can we estimate the income of a startup in some businesses where there are no sufficient stats to calculate with? So yeah, this is a very good question. When we do the revenue forecast for our valuation models, we are going to have to make a lot of assumptions. So this is a situation where we're never going to have as much data as we want, or as much information as we want, but we're going to have to make reasonable assumptions based on either publicly available data or data that we have from other startups. And if we use a robust valuation model, it is going to help us to check whether our assumptions make sense. We have a valuation model that we use. If you're interested to find out more about that, you can contact me or the organizers after the talk. So next question, besides tech-related business, are there any other industries that a VC might want to invest in? So typically most venture capital investment goes into three sectors, tech, healthcare, and clean energy. So outside of those sectors, there is very little VC investment. And this is because these are the sectors that have been and promise to grow most quickly over the next 5 to 10 years. And because VCs are requiring such high returns from their startups, they want to invest in companies that are themselves operating in fast-growing sectors. Now, interestingly, though, you might, for example, there's a very hot sector even in Thailand and Southeast Asia startups right now, food tech. So we've made some investments in food tech, and we were involved with SpaceF, which is a Thailand-based food tech accelerator program. And you might think, is that food or is it tech? So this shows how VC sectors work. Most VCs will not invest in traditional F&B, but they will invest in technology related to food. So outside those three sectors, very little investment. Okay, next question. What are key variables and assumptions in startup financial models that VCs look at? So, wow, yeah, that's a very good question, and there are a lot of variables and assumptions. So, but I would say everybody looks at the size of the market, so the market forecast, the growth rate of the market, the company's revenue forecast, the company's earning forecast, their margins, their cost of customer acquisition, and customer lifetime value. So I would say those are probably the most important variables and assumptions that investors will focus on in the startup financial model. What are the factors which are used to analyze the reliability of forecasted revenue or earning from startup activities? So yeah, this is a really good question, and it helps me make a point that I'm always love to make. The reliability of forecasted revenue or earnings in startup financial forecasts is zero. None of the startups that you model are gonna hit their earnings or revenue forecast. A very small number are gonna exceed, and most are gonna fail totally to achieve. So actually all financial forecasts, I believe, and definitely startup financial forecasts are not reliable. So we shouldn't make investment decisions based on the reliability of the forecast. We should make investment decisions based on the fact that the forecasts show the potential for the investment to succeed. If you think about the failure rates that we talked about earlier tonight, if 75% of the portfolio is going to fail to deliver 1x return, that means they're all going to fail their financial forecasts, which means 75% are failing. So these forecasts are highly unreliable. And the ones that succeed, they'll probably exceed their forecast. So I wouldn't worry too much about reliability of forecasted revenue or earnings as to assist you in decision making. If a company has different development stage, can we use different discount rate? How deviated is it? So definitely you can adjust the discount rate for later development stage. So in the seed stage, I would use 80 to 120%. Series A, I think we can start to look at something between 60 and 80%. Series B, 40 to 60%, and so on. So definitely we can adjust discount rate based on later stage. Because why? The probability of success will go up as the company raises subsequent funding rounds. Why is that? Because, not all companies that raise, let's say not all companies that go from seed to A will succeed, but almost all companies that succeed will have gone from seed to A. And same thing from A to B. Most companies that get to A and never raise B, they're going to be part of the failure pool. So if the company raises B, then the probability they're going to succeed goes up. As the probability they're going to succeed goes up, then the discount rate can go down. Different revenue multiple as well. So for revenue multiple, I don't think stage is relevant, because what we're looking at in the revenue multiple is the exit valuation, not the valuation at the current stage. So exit valuation should be the multiple that we use, exit valuation, should be the multiple at which we believe the startup is going to exit in the reasonable time frame, 5 to 10 years. And that shouldn't be affected by its current stage of development. That should be reflected by what we think the market conditions are. Now, how do we get those numbers? Also not easy. So best case is we look at comparable transactions. So if we can look at real M&A transactions that are happening in the market now, where companies are acquiring companies similar to the one that we're trying to value, we can then get the average of those transactions. If we can't get that, we might be able to get some sector averages for M&A transactions. If we can't get that, we can look at the multiples in publicly traded companies in the same sector, and then we do have to then do some adjustment for the fact that they're private companies. Okay, what is the best way for a government agency to finance startups? So, yeah, I think that's an interesting question. Not sure there is one best way. I think my preferred method I think there's two preferred methods for government agencies to finance startups. One is co-investment with VC investors, so matching VC investment and providing some sort of incentive for the VC investor or the private investor. And two is as a fund to fund, so government agency investing in VC funds who then invest in startups. Because in both of those cases, the VC funds are driving the investment selection and the returns. And I think that's what VC funds are really good at, and government is really good at catalyzing that. So I think government should, the most successful government programs to finance startups that I've seen both in in Thailand and in Singapore are public-private partnerships, either direct co-investment or fund-to-funds investment by government into venture funds. So what's the first thing that you look for in a company? I think everybody who's heard me before knows the answer to this question. I'm going to say the three things I look for in a company are team, team, and team. I really believe in investing in the people. I believe people create successful companies. Companies don't create themselves. Product market fit doesn't create itself. Strategy doesn't create itself. It's the team. I'm also very interested in innovation. So I love to, I'm drawn to startups that have innovative products, services, and business models. And I like to see that they're solving a painful problem for customers in a fast growing market. So but pretty much the first thing for me, it's about the team and the innovation. Please make one example of your most memorable failure in valuation and why. So most memorable failure in valuation and why. I don't have a memorable valuation failure because I'm very stringent in valuation. And I think you can tell from the talk that I gave tonight, and if you know me and have done any investment with me or negotiation, you know I'm very rigorous in valuation and tend to undervalue compared to other investors because I don't want to get in a situation where we make an investment and we overvalue the company. So even though we make the right choice, we make too low of a return. Maybe if I was going to look at most memorable failure, I have missed some deals. So there were some deals where there were deals that I would have otherwise liked to have done that I walked away from because valuation was too high. I felt was too high, and the company did succeed after that. So that happened a couple of times, but I don't lose sleep over that because still I accept that can happen. I accept that if we are rigorous in valuation, we're going to leave some deals on the table that are going to exit, but I still believe we're not doing a service for our investors in our fund if we don't price companies in such a way that if they succeed, they will deliver the required return. So for me, actually, I feel like if we fail to make an investment that gets to an exit but didn't deliver the required return, it's actually in a way worse than not investing in that company. So because if I invest in a company and at the right valuation and it fails, that's the cost of doing business. If I invest in a company at the wrong valuation, that's because I believe that's because I didn't do my job. How to find industrial M&A multiples, 5x. So this is another challenge in doing this type of valuation because there is a lack of data and public information. Usually we combine secondary research, publicly available data with some research. We very rarely purchase research reports, but you can do that. There's definitely analysts that cover most of the markets that startups are going to be operating in, and you can buy research on that. You can get it from investment bankers. You can get from financial advisors who do collect this information from private transactions. And also you can get from your network who know about transactions that are taking place in our market. But again, be careful there. Try to make sure that you're getting a large enough sample when you use that type of data. Next question. How can you know that the prediction of 5 years revenue is correct? Because the company in the seed round. Sometimes it might not be clear yet how the company makes money. I agree 100%. The 5-year forecast is always wrong. It's always going to be wrong. It's no better than random. So we don't do the financial forecast to be correct, and we shouldn't expect financial forecast to be correct. Because if you think about it, financial forecasts can never be correct because they're predictions about the future and nobody can predict the future. So don't worry about, I don't worry about financial forecasts as wrong. It's supposed to be, it's not supposed to be right. It's not a prediction exercise. It's useful in valuation because, not because it predicts what's going to happen, but because it tells us that if this is what happens, then we can generate the required return. it demonstrates that given a reasonable set of assumptions, a reasonable financial model, there is and a reasonable set of inputs, there is at least one scenario under which this company can deliver our required return. That's what we get from the financial model. Don't make the mistake of thinking that you get a prediction from your financial model of what's going to happen. Nobody can do that. Nobody can predict what's going to happen for startups. Nobody can predict what's going to happen. Even publicly traded company financial forecasts are wrong all the time. Nobody can forecast any future prices with better than random accuracy. What is the linkage between interest rate and valuation except Dcf method? Linkage between interest rate and valuation except the VC method. So I think in a traditional VC method, the risk-free rate would be one component of the valuation. But for us, we don't have to worry too much about that because that usually applies to the debt financing part of the equation, which we don't include. We look only at equity finance companies. So we don't typically have to factor interest rate into the comparables or the VC method valuation. So because VC funding, it's typically all equity funding and the startups are all equity funded, we're generally not too concerned about interest rates. Oh, so there was a question, valuing the VC method, why do we use 60 to divide exit valuation of 150? So 60 is because of the 30x return required at the seed stage, accounting for 50% dilution. So that means because 50% is 100 divided by 2, so we multiply the 30 by 2 to get 60. And we would use that same 60 no matter what the exit valuation. So this, if not clear about this, contact me after the session. I'm happy to go over it again in more detail. If the target company startup have business feature like half SME and half startup, what's the proper method for valuation? Can we still use VC method or combine with others such as DCF? So if we're a VC, I wouldn't invest in a company that's half SME and half startup. So VC should only invest in company that's 100% startup. And I think also if I would say the same thing if I'm a non-VC investor, I also wouldn't invest in a company that's half SME and half startup because and I think the reason being, one of the things we probably learned from today's lesson, today's class is the methods of valuing VC, valuing startup and SME are radically different. So if a company is both or trying to be both, the valuation is going to be pretty impossible to arrive at, and neither investor is going to be satisfied, going to be happy. If I'm a SME investor, then this investment is going to be way too risky. If I'm a VC investor, then this investment is never going to pay the required return. So I would say if a company is half SME and half startup, they should choose which way they want to go, SME or startup, and then value appropriately.
Okay, the next question is in Thai from Kun Vishian. The question says, how do we find the median industry average and whether we should be using the international standard? Thank you.
Yeah, so I think I answered the first part of that question already. So where do we find the data? But the second part is really good. Like, should we use what geography data should we use? If we're a Thai startup and we're going to sell to a Thai company, then we should use Thai data, Thai market data. Now, ideal case. If we're a Thai company, we're going to sell to an international buyer, then we may want to look at international data. And this is also going to be influenced by availability of the data. So let's say we want to do all Thai deal, but we can't get the data in Thailand. So we might have to use Southeast Asia data or ASEAN data or even a global data and then adjust for the market that we're investing in. So oftentimes we won't be able to get exactly the data that we want, and we will have to make some adjustments to it. In case you forgot about in case anybody forgot previous answer, where are we going to find the data? So combination of our secondhand data and firsthand data. So the secondary research and also our own market knowledge. Next question, what is the best valuation method for a company aged 6 years? So if it's a startup seeking VC funding, then I think VC Method is the best. And VC Method doesn't matter how old the company is. So if they're 6 years or 5 years or 2 years or even 6 months, we can still use VC Method. How will we be sure that the revenue multiple that we use makes sense? Do you have guideline other than past M&A in the industry? So again, one very important point, we never be sure about anything and our financials make sense. And we can only do the best that we can to get the highest degree of confidence, but there's no guarantees in this business. So don't worry too much about being sure. Past M&A activity is definitely one great source. Other good source is analyst report, market research, and also if we can't get M&A related multiples, we can use publicly traded company multiples, but adjusting for the fact that we're private companies. Okay, next question. Where can Thai startups raise fund easily beside Thailand? Can it be Singapore? So I think it's never easy to raise funds. Typically, it is most likely for the startup to raise funds in the market where they're operating. So for example, most Thai investors have a strong preference to invest in Thai startups. Most Singapore investors have a strong preference to invest in Singapore startups. Same thing in the US. Most Silicon Valley investors typically have a strong preference to invest in Silicon Valley companies. So I think the first stop for your fundraising should always be your current geography. I mean, assuming the company is going to stay there. Some Thai startups might move to Singapore to raise money or set up a Singapore company to raise money so they can tap on Singapore investors. And there are definitely investors in other countries, Singapore investors who invest in Thai startups, Thai investors that invest in Singapore startups, but first stop should be your local investors. How can you value Bitcoin or cryptocurrency mining company? So I think I would still, assuming that the company is planning to do a traditional exit. So there were a few years ago, a lot of cryptocurrency or Bitcoin related companies were doing ICOs or initial coin offerings rather than IPOs or M&A. That has fallen dramatically out of favor in the last few years. So assuming that the cryptocurrency driven or Bitcoin driven company is planning to go to a traditional exit, trade sale or IPO, we can still apply the same VC method. Again, you can see why I love VC Method so much, because VC Method answers many challenges in startup valuation. Next question. In my opinion, are VCs considered to be innovators? So, I mean, VCs are investors. So usually I would consider startups to be the innovators. Some VCs may be more or less innovative in their approach, but I wouldn't say most VCs are innovators. They're more investors. Most of the innovators, if you think about who are the innovators in the enterprise ecosystem, the startups are the main innovators. What is consequent effort of SPAC in private equity market? So I'm not really sure about that. So I'm going to have to skip over that question. But if whoever asked that question is really interested, we can discuss offline after some additional research. Okay, next question. How to calculate the valuation of a startup who is developing an e-marketplace platform and does not have revenue yet? Can we use transaction amount, not revenue? occurred on the platform, and how much will it be? So again, the valuation of a startup who's developing a marketplace without revenue, we can still use VC method, because VC method only requires exit valuation. Now, I think maybe what this question is getting at is, at the exit, we can't do a revenue multiple, even they're going to get to the exit with no revenue, so we can't do a revenue multiple at the exit. Could we use transaction amount? So we call that GMV, gross merchandise value. You can apply it is possible to value marketplace company using a GMV multiple, but most GMV multiples are much lower than revenue multiples, because obviously revenue is going to be a percentage GMV. So if you're using GMV multiples to value a company, make sure you're using a realistic GMV multiple. One big mistake I see a lot of entrepreneurs, marketplace entrepreneurs make, they quote their GMV as revenue. GMV, it's not revenue. Revenue is the revenue that the marketplace makes on the GMV. And again, this can put you in a really bad negotiating position if you valued your company on a GMV revenue multiple and called it revenue. Is the formula VC method a normal practice for the industry? Can it be applied to any startup? Yes, the VC method is a normal practice in the industry. I didn't make this up. I didn't develop this method. It's a well-known and trusted method of valuing startups, and it can be applied to any startup, which is why I think it's so valuable. Do you think the VC method can be used for small cap listed companies? And if so, what number should be used to divide? So I wouldn't say the VC method should be used for small cap listed companies, because the listed companies, again, they can generate value for shareholders, both with dividend and with capital appreciation. And also VC method, it's assuming exit, and the small cap company has already exited. They're already listed, so they're not going to most likely be relisted or subject of an M&A. So the end point of the VC method is not going to really make sense with a publicly listed company. But an interesting question, I guess. I never really thought about doing this. I guess at some level, it might be possible to adjust VC method to make it work with publicly traded companies. But as far as I know, that's not the case. Valuation method, which one is best? I think everybody knows by now I have a very strong preference for the VC method. I like to use the Dcf method and comparables method to make sure that my VC method is within reality check of the other two methods. You have not, next question, you have not mentioned much about timeline. Can you elaborate the issues regarding timeline of investment and your expected return period? Yeah, so thank you for that. I didn't talk about timeline because most VC funds have the same timeline. The fund is somewhere between 7 to 10 year lifetime. So for the vast majority of investments, we're looking for return between 5 and 10 years. The investments that we invest in year 1, we look to exit by year 5. Investments we make in year 2, we look to exit by year 6. And so on up to year 5, we look to exit by year 10. So the one very important point there is if you are getting investment from VC fund, you probably would like to know where is that fund in the fund lifetime, because the newer the fund, the longer period they'll have to exit. If the fund is already, for example, in year 4 or 5, they'll have a typically shorter time horizon. Next question. When 10-year U.S. Treasury yield goes lower and lower, like nowadays, would you decrease discount rate to be lower than 80%? So yeah, we usually don't adjust our numbers based on current market conditions, because why? So we're making an investment today. We're looking to liquidate that investment, let's say 5 to 10 years from now. So the current Treasury yields not really relevant for that transaction. This transaction is which is actually, one of the great things about VC investment. VC investment returns, although they have the power law distribution that I talked about earlier, they're also highly uncorrelated with public equity returns and with most investment returns in most portfolios, because we're investing so far into the future. So we're looking at very long-term returns, and therefore we don't have to worry too much about things like interest rate. I also don't worry about what's happening in stock market. So bull market, bear market today, don't really worry too much about how that affects my valuation, because again, 5 to 10 years from now, who knows what the economic cycle is where we will be in the economic cycle. So how does VC fund estimate returns to LPs? So so we have a fund. A VC fund will have a fund model. We have one where they'll model the strategy. So model the investment strategy based on how much money they're investing into how many companies, what are the exit strategy that we're going to have for those companies, and we'll be able to calculate the potential return from our fund to investors. Again, this is not a prediction of the future because there's a lot of volatility in that forecast, but VCs will have their own fund. VC fund will have their own model to do this type of forecast. How do you calculate exit valuation? So I think I talked about that already. What price to revenue multiple you use? I think I addressed this question also. We will use the sector relevant multiples, looking at comparable transactions and also sector data. How can we confidently know exit valuation is achievable? I think everybody knows the answer to that question. We can't be confident. We don't know it's achievable. We're going to have to make a calculated bet on that and hope that it turns out like that. But we should understand that exit. But to answer the question a little more precisely, this is what we will learn from our financial model. We won't learn what the exit valuation is going to be, but we will learn that it's achievable. Now, how confident are we in that? For me, I'm not more than 20% confident, because I know the data bears out that 80% of the investments won't hit that exit valuation. If startups are not in Southeast Asia, but in the US, how would formula be different? So the main difference in the US is higher exit valuation. So in the US, if a lot more startups are doing IPOs, and therefore average exit valuations will go up, the rest of the calculation shouldn't change much. So the formulas in, for example, VC method shouldn't be much different, but exit valuations can definitely be higher. And in fact, I think that's the biggest difference between US and Southeast Asia-based valuation and startup economics in general. In the US and China and a couple other markets, startups can exit at, on average, much higher valuations than in Southeast Asia today. This can change over time, in which case the valuations will converge. How can we know how much we should multiply year 5 revenue? So I think, I answered this one already. Why most startups fail? So I'm going to answer that because most startups fail because they have to fail. Because if you think about what does it mean for a startup to fail? When we look at, when I talked about what type of companies do VCs invest in, we're going to invest in companies that have the potential to become number one in their product category in their market. Number one means only one company can do that, and all other companies trying to do that are going to fail. So by definition, successful startup will be very rare, and the vast majority of startups will have to fail. So I have another program where I talk a lot more detail about this. So I would recommend you join one of those sessions if you're really interested in this topic, and I talk a lot more about failure. So unfortunately, I think I have reached the end of my question and answer period. So I'm going to have to end here. I have a few questions left. If I didn't get a chance to answer your question and you would still like to get the answer, feel free to contact me after the program. I'll be happy to answer your question in email or in social media. I'm on all the social media and have all the chat program and messaging programs. So feel free to contact me with any questions that weren't answered tonight or any other questions that you might have about this topic or anything else related to venture capital and startup. And thanks so much, everybody, for your kind attention tonight and for all your great questions. I really appreciate it. And I hope that you learned some secrets of VC valuation tonight.